In this video, we explore the bold and disciplined approach of Francis Hunt, professional trader, educator, and creator of the Hunt Volatility Funnel method. Known for his no-nonsense style and deep technical insight, Hunt teaches traders how to think in probabilities, define clear setups, and execute with precision. Far from the noise of indicators and predictions, his philosophy is rooted in structure, patterns, and logic, always with an eye on managing risk and maintaining control. For Hunt, trading isn't about being right, it's about having a process that works. From the ComLucro archive, we've selected 7 of his most impactful lessons. A masterclass in trend following, chart preparation, and the mental game behind every decision. And it all starts with the hard truth most traders ignore. If your rules don't guide your actions, you're not trading a system, you're gambling.
There are so many things you would need to do to become part of the 9%. If it were that easy, everyone would be part of it. And there's a lot of intelligent people making up part of the 91%. And in fact, you will always vacillate. You'll be in the top 1 and occasionally you'll be outside the 9%. But what you do need to do is you need to potentially decide on a strategy that looks after all elements of money management. And we've discussed the risk reward, we've discussed losses. You've got to manage losses, that keeps you in the game. You've got to believe you have a system that will make more than it gives back on its winning. It will win and will lose all the time. No one is ever going to have 100%. So accept that losses are part of the game and manage that. Become as systemic as possible in determining what your setup is. So the more it can be reduced to logic, the better. And then you need to stick to the system as systemically as possible as well, which most people are incapable of with emotions, particularly after, say, 3 losses. You'll be snakebite fearful, and after 3 wins, you'll be piling on twice the size. And that'll be the one that'll lose and give back all of those 3 wins and some. So that's where focusing on if you had to develop a black box system is not a bad process for defining your strategy and that which you find interesting. Observing charts, a lot of observation, a lot of drawing of charts, and a lot of use of patterns. Patterns are probably the most powerful technical analysis tool for me outside of the larger trend Dow theory.
The foundation of Hunt's approach is simple. Trend is truth until proven otherwise. Rather than chase reversals or call tops and bottoms, he focuses on identifying where value is being redefined and then riding that movement with structure and clarity. But conviction alone isn't enough. In the next clip, Hunt explains why confidence comes before the trade, not during it, and how deep chart preparation creates the calm, focused mindset needed to pull the trigger with precision.
Why did I leverage up and revenge trade?
Most trading mistakes made by beginners, even intermediates and occasionally even advanced people when they lose their heads is to do with trade sizing. So they take a loss too big. There's no damage done in taking your managed loss. That's part of the game and being wrong. The problem is that recovery ladder when you then emotionally negatively respond to taking an already slightly bigger loss. So let's say you lose 15 or 20% and then you think, damn, I want to get back to where I was, so I need to make 25%, so I'll trade bigger again, I'm sure I'm right this time. It's like a mental cognitive dissonance that makes you need to get back to where you once were, because you're now seeing yourself as the lesser self as dictated by this balance. And that then pressurizes you into trading bigger again on what looks like a sure thing. But now you're punch drunk because you must find an opportunity quickly. And it's not a sure thing. It's the first thing you grabbed hold of that best represents a possible trade. So you then bastardizing your criteria to grab hold of something that you expect to leverage you back into where you once were. This is a very big fatal spiral, because once again you then overtrade because you've got to make back more to get back up, and that's the recovery ladder concept, and boom, that is probably the single most destructive that sees someone have a £10,000 account reduced to, you know, a few hundred or £1,000 and then virtually giving up, realizing that they've blown it. I wouldn't say 91% are in that category. They don't all blow their accounts up from £10,000 down to 9, but they aren't possibly consistent with money management as a whole. And sizing is one element of money management. Don't forget, I said risk reward should be central to that as well. So they're taking trades that aren't worth the squeeze. The juice isn't worth the squeeze. And the probability of win rates, they haven't tested what likelihood they have of winning. Too tight a stop. something else I've mentioned. All of those things all fall under the larger money management cluster, and those are all key.
Hunt leaves no doubt. Poor money management isn't just a beginner's error, it's the trap that takes down traders at every level. From revenge trading to emotional sizing, it's a silent killer that feeds on undisciplined thinking. In the next clip, he goes one level deeper, exposing how vague rules and improvisation destroy even the best strategies. If your system isn't clearly defined and rigorously followed, you're not testing a plan, you're testing your luck.
So tested strategies, I'm assuming you're talking about something that's systemic, where you can actually run almost black box and you generate notional trades. In that instance, I feel the biggest advantage of a tested strategy is actually the process of defining the strategy in the first place. Because too many people, when I speak, and this is once again my value of having taught traders, that they say, here are my rules. And then when I watch how they implement them, they actually say, well, I didn't do that one because of that, and I didn't do this one. So I said, well, where's that as part of your rules, though? So you're actually discretionally bending the initial rules that you wrote down, because you're not actually trading your actual system in terms of how you defined it, or you're actually adding a new level of rules that you haven't yet incorporated into your rules. So one or two has got to happen. You've either got to stop messing with what you originally wrote down and trade what you've defined, or if that which you think is an important criteria, define that criteria and reintegrate it into your system. So what you actually find is you start being forced to make decisions about what you really want. You can't get what you want in life until you define it and can write it down. So in the same way in trading, you have to say, I'm going to have to let some of those trading patterns go. I quite like them, but sometimes they really sting you. They go the wrong way. And when they do that and that, it could be good, but it could be bad. Let's just focus on the ones that give me the results that I always need. And you're being forced to eliminate and to define. That process of defining the system is the most valuable part for me. The testing then gives you the outcomes of that work and tells you if you're basing your thinking on a failed fallacy or not. If you can't make over a long run a reasonable return on testing, you will never make it in reality on that. So the testing is a clear point of where your idea is put to the sword if not justifiable. And then you are living in a fool's paradise, so you must come up with another system. But at least it gives you closure and you can let it go.
Clarity without structure is still chaos. Hunt shows that the real power of a system isn't in how it performs on paper. It's in how clearly it's defined, followed, and tested under pressure. In the next clip, he breaks down how time frames fit into that structure. From spotting the trend to timing the breakout, Hunt reveals the layered approach he uses to align direction, pattern, and execution, with the precision of a sniper and the discipline of a veteran.
Time frame's a good question, and it's something that in terms of my strategy, I've come and found my own truths. I'll share that. And as I trade a trend, with a trend, I don't look to pick reversals because often reversals have a lower success rate and they don't turn out to be reversals. So on basis, I change continuous patterns. I have a trend time view. I then have a pattern view where I'm looking at the setup as it is the squeezing of the volatility. It stopped going up for a while, it's resting. And then I have what I call a trigger time frame, which will be the time frame whereby you're actually looking at the specifics of the market to get your unique high 3 point and when the breakout is going to happen. So that is very focused on timing. So one is, which direction is the river flowing? You know, is it flowing, where is south, you know, downstream? Get that right. That's your macro time frame. So typically the best time patterns are taken on the larger time frame. They're more consistent broadly. You're less likely to be flicked out, particularly if you're in Forex. A variety of other underlying markets can be a bit choppy at times. So I would say you want a trend time frame, which is maybe a daily chart, can even be weekly or monthly, to H4, 4 hours. Your pattern time frame where you're looking specifically at the setup and identifying the aspects of it. So if I'm talking about a symmetrical triangle, you know, your 3 highs, your 3 lows, the pinch, that would be 1/4 thereof. So if you're on a daily on your trend time frame, I would be on my pattern view 4 hourly. And then when I'm looking at just that third high and that third low and that move that takes it through the high 3 that reasserts the bull trend, that would be my trigger and timing, the time frame. I want to really pick that third high and get that stop neatly nailed and the point at which I enter with a pending order. Note also it's a pending order. In other words, the market must take you in. This actually eliminates a lot of bad calls. In other words, if it breaks down and is a reversal instead, you don't get taken in. Most people are getting in on market orders because they say, oh, I must be in. The market's moving and they jump. They're momentum chasers by our default, because you want to be excited. It's going up. You want to be part of it. You chase the train. So a pending order is more about a price level falling than a specific moment in time that you want to be in the market. So that trigger time frame would be a quarter of the 4 hourly. So you would have a daily trend, you would have 4 hourly pattern, and you would have 1 hour for capturing that final third high and third low, which represent the breakout and the stop loss placement. Bang, those are my 3 time frames. So I'm actually looking at 3. The first one, once you've got that right, it's nailed, you can set aside. Then you concentrate on the other 2.
With time frames aligned and structure in place, Hunt makes one thing clear. Precision isn't about prediction. It's about preparation. Every move has its context, and every breakout needs the right setup at the right scale. But not all tools are created equal. In the next clip, Hunt challenges one of the most common traps in technical analysis: blind faith in indicators. He explains why many popular tools actually distort decision-making, and how price itself should always come first.
Technical analysis, it works for me, certainly, but I've selected the elements that I believe work, and it does have limitations. And there are certain aspects of technical analysis that I largely leave aside entirely and are critical of. This is quite controversial as well. So I feel one of the key things people get introduced to in technical analysis, they get straight away taught indicators, and they get taught moving averages. They get taught a variety of what I call the lagging category of derived lines. So essentially price data, which is the facts and the truth and the reading of the tick, is being de-emphasized. And often I find early traders will have, price chart here, and then 2/3 of the chart will be filled with 5 or 6 derived lines, which are essentially mathematical formulas placed on different points of the price data. And there's nothing predictive about that. But what tends to happen is people begin to make associations psychologically that there's a predictive element. In fact, most of the ticks up in the indicator will always be generated by first a tick in the price. So inherently, most indicators are lagging. And everyone will say, oh, but you got the warning there. Retrospectively, when you move the point that you draw the line up on the indicator, it actually looks like it gave early warning. But only after the price data has moved it has it done so. So people get confused and they start to think the tail is wagging the dog. The price behavior is your best and should be your primary part of your analysis. And I feel personally that there's too much fascination on indicators. The other thing that is wrong with indicators for me is that invariably people get into the habit of calling tops and bottoms. So if you have an RSI, they say, oh, there's divergence, it's not going up as quickly, therefore it's losing some of its momentum. But actually, if you've had a very strong impulsive move on the price, any move up after that will look less significant. However, you can go into for a trend for a very long time. So it has people always taking the other side of the market in terms of the trend. So it actually encourages not following the trend. And so those elements I'm very critical of. Volume is a notable exception. Volume can often precede price moves, and I value that. And things like Bollinger Bands that capture volatility, because I trade the expansiveness of the volatility and the tightening of the volatility as part of my strategy. I find things that illustrate that very, very useful. So it's not a broad brush, but most indicators, unfortunately, have limited value in technical analysis, and I wish the art or the science emphasized them far less. I think it's killing a lot of traders' future and leaving them feeling a bit helpless.
Hunt doesn't just question indicators. He dismantles the illusion that they can predict price. For him, the chart itself is the signal, not the lines we draw after the fact, but the raw structure, momentum, and behavior unfolding in real time. In the next clip, he expands on that philosophy, revealing why preparation before the trade matters more than execution itself. Like a sniper or a prize fighter, the real work is invisible. The click is just the final act of a much longer process.
The charting is all the work for me. Finding the right stuff. If I'm a sniper and you ask me, how much is the getting camouflaged, observation, waiting, looking for that shot, keeping fed, nourished, sustained, unobserved, and the actual pulling of the shot, which percentage is, the bigger part of the work, you would actually say, well, clearly everything that was in the first instance is all the work, and the shot is literally the coup de grace moment of just key acknowledgement where all the work manifests itself. In the same way Muhammad Ali, when was pointed out that you had that one fight with Joe Frazier was over in a minute and a half and you got paid X amount of dollars, and that effectively meant you earned during that time the ludicrous sum of X million dollars per second. And he actually said, but hold on, who was paying for me when I was running on the pavements in the streets 15 years ago and hitting a punch bag in a rundown district with nothing but my dreams? So in essence, the work is all done on the charting. The actual trade element of implementing, putting it on, the order placement, is almost like the pressing the button. It's a very small element. It's the pulling of the trigger. It's the small element. It's important, and what happens post is the in-trade management, which largely you should be leaving for your pre-agreed levels.
The real trade happens before the trade. Hunt reminds us that great execution isn't reactive. It's the final step in a process that begins with quiet, focused preparation. In the next clip, he dives deeper into what that preparation looks like: multi-market analysis, pattern recognition, and the tireless habit of reviewing setups before they happen. For Hunt, the traders who win don't just act, they anticipate.
You start putting 91% into your chart analysis and looking at it across intra-markets. Say you're looking at buying gold. How's the gold doing relative to the dollar? Is it the dollar? Have you looked at gold versus the euro? You're doing all this intra-market analysis, looking at all the patterns, drawing every pattern in the run-up, seeing where all the key levels are, seeing how it's interacted with all the key round numbers, looking at the volume, where's the volume been building up, looking at the volatility, seeing if your setup is potentially a downside setup and comparing it with other similars that you've taken. You're doing some of these things that are only some of what I do before a trade. You do that 91%, you're going to be part of the 9% on balance most occasions. What actually happens is people spend most of the time being in the trade and hitting the trade and trading in and out, and very little of that is actually in the pre-trade preparation. And it's like anything, People used to say about Kevin Peterson for his batting, you put an immense amount of time in the nets. And then they'd say, oh, he's a good batsman, look at him swinging the bat. And they'd forget about how much work has gone into it, beforehand. You see him playing in the test match. That's a fraction of what he's been doing on the batting front.
From chart structure to market context, Hunt leaves no doubt. Consistent trading isn't about reacting to the market, it's about preparing for it. The edge isn't in prediction, but in process. Discipline, definition, and deep observation are what separate the pros from the rest. And for those willing to put in the 91% of work that happens before the trade, the results can follow with surprising clarity. Now that you've seen Francis Hunt's most impactful lessons, from structured systems to risk management and execution, let's bring them together. Here's a 7-step framework inspired by his teachings, designed to help you build a disciplined, logical, and long-lasting approach to trading. Let's break it down. Step 1. Accept the 91%. Here's the hard truth. Most traders lose, not because they're not smart, but because they ignore process. The 9% who survive treat trading like a craft. They don't chase signals or quick wins, they build systems and they stick to them. Step 2. Build a system you can actually follow. It's not about being right every time. It's about having a strategy that works over time, even when things get chaotic. And that only happens when your rules are clear, tested, and followed without emotion. If you're bending the rules mid-trade, you're not following a system, you're improvising. Step 3, respect the recovery ladder. We all lose trades, that's normal, but trying to win it back by doubling down or revenge trading, that's how accounts get blown up. Position sizing is not just a technicality, it's one of the biggest killers in this game. Manage it like a pro, or the market will manage it for you. Step 4, let structure lead. Markets aren't noise, they're layered. Hunt uses 3 time frames: the trend, the pattern, and the trigger. Each has a purpose. Structure creates clarity. And once you see the layers clearly, the trade becomes simple. Not easy, but simple. Step 5. Stop chasing indicators. Most indicators are just math chasing price. They don't predict, they react. And if you're basing trades on what lagging lines are telling you, you're already late. Hunt's message: focus on the chart itself. Price is truth. Patterns, behavior, and volatility are your real tools. Step 6. Do the work before the trade. Execution is the final click, but the real edge comes long before. That means marking levels, studying volume, comparing markets, and waiting with purpose. Hunt says it best: the chart is the work, the actual trade is just the release. Step 7. Think like a sniper. The best trades, they're not exciting, they're boring. There's no rush, no adrenaline, just readiness. You've done the work, the setup is there, and now it's just about pulling the trigger with discipline. Because in the end, that's what separates the gambler from the trader. So, if you're ready to deepen your focus and sharpen your system, the Strategy and Execution playlist is your next step. It features insights from Francis Hunt, Linda Raschke, Al Brooks, and other master-level traders, all focused on one goal: helping you build a repeatable edge in any market. Because in trading, chaos is guaranteed, but how you respond is a choice. I hope you enjoyed today's video. If you found the content helpful or engaging, please give it a like, as this helps the video reach more traders like you. And don't forget to subscribe to the channel and turn on notifications so you never miss our latest insights on the markets and practical trading strategies. Sharing this video with your friends or on your social networks can make a big difference and helps our community become stronger. Now, if you want to go even deeper and get access to exclusive content, early video releases, and extra tools to support your journey, consider becoming a member of the ComLucro trader community right here on YouTube. It's a way to support our work and a smart investment in your own development. Thanks for watching, and I'll see you in the next video.